And cash, and we'll see what some of the learning objectives are here in just a moment. We'll talk about Sarbanes-Oxley, we'll talk about internal controls, applications of internal controls to cash, and then controls around a bank account that controls cash. So quite a few things to talk about. Another one is then to talk about bank reconciliations. And there's a few more here. Describe the accounting for special purpose cash funds. Describe and illustrate reporting of cash for financial statements. And then there's one more. We'll talk about some ratios in terms of cash. Okay, so let's first spend some time talking about Sarbanes-Oxley. And we can see right here, it was passed back in the summer of 2002 by the Bush administration, named after two congressmen. Paul Sarbanes was from the Senate and Michael Oxley was from Congress, from the House of Reps, and it applies to companies whose stock is publicly traded. Okay, so any company that you and I can go and buy the stock of through Scottrade, E-Trade, any brokerage service, that company is subjected to the Sarbanes-Oxley law. There are some requirements. If a company is small enough, they would not be subjected to it, but the vast majority of companies that are publicly traded will be required to submit to the Sarbanes-Oxley requirements. Sarbanes-Oxley put a lot of emphasis on internal control, and just so you know a little bit about the background about why the law was even enacted. It was enacted as a result of two big companies intentionally falsifying financial information, basically both Enron and WorldCom, and they were doing their stuff back in the late 90s. And then, if you can recall, 9/11 happened in 2001, which caused a recession, and that recession just basically caused this the frauds that Enron and WorldCom had perpetrated. They just couldn't hide it anymore. And so obviously those companies, their stocks were worth nothing. They both went bankrupt. Anybody who owned their stock was out those funds, and there was lots of issues about investor confidence. And so Congress, in relation to that, passed this law to try to restore investor confidence. And one of the biggest issues with Enron was just the fact that basically what happened was, think of it this way: the public auditor in the auditor firm was Arthur Andersen, and Arthur Andersen failed in their job. Okay, and primarily with the Enron company. Arthur Andersen's Houston office made a little bit of money on the audit, but they made a lot of money, and we're talking tens of millions, by consulting for Enron. And because of the amount of consulting dollars that they made, they were not truly independent. And because they were not independent, they were not willing to tell Enron, we figured out what you're doing, that you're intentionally falsifying information, stop it. So they just wouldn't do that. And so they were complicit in the fraud, and that company no longer exists. So that was a bit of the background. And so internal controls were basically believed to, if they were better, would have stopped this or prevented it from happening. And so a lot of emphasis was put on internal controls with this law. And so internal control is basically just described as any process that used to safeguard assets, process information accurately, and ensure compliance with laws and regulations. So obviously controls have been around for a long time, but Sarbanes-Oxley put more intention on those controls and requires companies to spend more time documenting, auditing those controls. And an audit of controls must be done once per year. So just some things to think about are the timeline here, which I've already mentioned. Basically, I mentioned WorldCom and Enron, another company called Tyco. And if you look up these companies, what happened is that executives at the top of these companies CFO, COO, just top people, presidents of companies, they intentionally, on purpose, falsified financial information so that they could have a higher stock price and be able to get bank loans. Okay, so basically, then they were just taking that cash, quite often using it for personal gain, things like that. So it was called fraud and theft. And then when it became public that this had happened, of course, there was a lack of confidence in investors, stockholders, and creditors. And in fact, a company that I worked for at the time, down at Sandwich Financial Group, had $25 million worth of bonds from Enron, and ultimately were worth nothing. Now, there were settlements and lawsuits, and there was some partial recovery, but $25 million of bonds, and that was just one small example. And this was, to the tune of hundreds of millions of dollars in terms of just loans, not let alone the stock price basically going from a very high number down to zero. So Congress passes this law. It was signed in the summer of 2002, and it's one of those bills that really didn't have a lot of debate. Everybody kind of knew it needed to happen. It was passed in the summer, and then companies were given a couple years to go through the process of implementing it, which I was a part of that, of designing controls and ensuring compliance with it. And so it really put the emphasis on controls and more documentation, more annual review, being much more intentional about controls, and signing off on things, and ultimately doing an annual report on the effectiveness of your controls. So the goal, of course, was to minimize fraud and theft, and to basically restore confidence to investors, stockholders, and creditors. And so this is just an example of some information, report of Nike about Sarbanes-Oxley. And it says here, management is responsible for establishing and maintaining adequate controls. Under the supervision and the participation of our CEO and CFO, our management conducted an evaluation of the effectiveness of our controls, and based on the framework of internal controls. And there's basically something called the Treadway Commission, which has been around for a really long time. And basically it's made up of members of lots of interested parties that are interested in having good controls. And so that, of course, is representatives from industry, education, government, various industries, AICPA, and so on. And they developed a framework of what a good control would look like. And if a company has good controls, here's all the here's how to do it, here's the policies and procedures to include in those controls, and so on. So when they mention the Treadway Commission, that's what they're talking about. And then PricewaterhouseCoopers was their auditor, and basically has said, we agree with the controls being effective. Okay, so that's a little bit of background about controls. Of course, we need to make sure that controls are effective. And we talked about the elements are to safeguard assets, provide accurate information, that's your financial statements, and ensure compliance with laws and regulations. All three must be done. Obviously, one big thing you're trying to prevent with good controls is employee fraud, right? You do not want your employees to steal from you, and you want to make it difficult for that to happen. So basically, employee fraud is an employee intentionally deceiving the employer for personal gain, okay? Ultimately trying to steal cash or resources or misuse them in some way. So some elements of control. It says here management is responsible for designing and applying the 5 elements of control to meet the 3 internal control objectives, and they are right here. The control environment, risk assessment, control procedures, monitoring, and information and communication. We'll talk a little bit about each one here in the next few slides. So these elements of control then, and we kind of talk about it as being the shield of internal control, and they mention it here as an umbrella, right? We've got control threats that are bouncing off of our control environment if it's set up good, right? Shielding or protecting management and the business from these control threats. So think of it as a shield, as an umbrella. I've seen different books kind of use both of those analogies. So the first one we can talk about is the control environment. Basically, what is management's attitude regarding the importance of controls? Okay, sometimes I've seen this called the tone at the top. How important does management say and act on the importance of controls throughout the organization? Are they setting a good example? Is there training? Is there consequences to not following controls? Things like that. So you can see here it's made up of the 3 points of management's philosophy, the structure of the organization, and personnel policies. So all of those go into the control environment. And when an auditor is new to a company and you're coming into a company for the first time and assessing controls, this is one they're trying to figure out right away, is what the control environment is. And auditors do this by interviewing employees at all levels of the company. They'll interview the top people of the organization and get their statements and beliefs about how important controls are. But then they'll go on to interview people at the lowest levels, at intermediate levels, and try to match up. If top management said controls are really important and we offer training and there's consequences if you don't follow them, and then you find out that lower level employees are saying, I've never been trained on controls, I have no idea what those are, there's a disconnect, right? And that's what auditors are trying to figure out. So that's the reason that this one's important. The control environment then, of course, is made up of the CEO at the top, who sets up an organizational structure, which of course includes employees, personnel policies, and management's philosophy. So all those things are supposed to be working together to make sure we have a good control environment. That's what you want to find out. Okay, of course you can find out that they don't work together also. Control procedures are just simply the procedures that provide some reasonable assurance that the business's goals will be achieved. Okay, and so some examples here: competent personnel, rotating duties, and mandatory vacations. So think about competent personnel and think about maybe a job interview that you've had and think about what kind of questions were asked of you. And those questions should be designed in a good interview to make sure that the right people are being found for the right jobs. Do you have the qualifications, the right attitude, things like that? I can recall some interviews I've had in previous years where before I even showed up at the door for the interview, the company had me take some kind of an online assessment. They sent me an email with a link. I go and I take that, and that kind of tests my attitude, aptitude, my abilities, and then they come in and they ask me questions based on how I did on that. They're trying to find the right person with the right attitude for a particular job. Not only the importance of having the right skills and education, but the right attitude. So that's what they mean by competent personnel. Rotating duties. If you know that you're only going to be doing your duties for a certain amount of time, odds are you're not going to try to come up with a scheme to defraud the company, because let's say every 6 months you do a job rotation. I basically, if I do this, I have to cover my tracks. If somebody else is going to come in and do my job after 6 months, are they going to find what I did? That's the question, right? So there's enough doubt in my mind that I'm probably not going to do it. Same thing with mandatory vacations. Having done a lot of classes that involve controls and audits and things like that, I've used a lot of casework, and I've seen cases where everybody lauds, let's just say, employee Joe, and Joe's a great employee, never goes on vacation, he's always there working hard. Well, it turns out Joe gets in a car accident, and Joe is in the hospital recovering for a while and can't come back to work for a couple of months. And so somebody has to step in and do Joe's job. And that person begins to realize why Joe was always there, because Joe was stealing for the company, and Joe knew if anybody else did his job, they'd figure it out. And so that's what they mean by mandatory vacation, requiring people to step away, take a certain time off, and let somebody else come in and do that job while they're gone. And so that threat will hopefully prevent a few people from trying to defraud the company. Separating responsibilities, we'll talk about that one more with some examples later on. But for example, in accounting, you would not give any one person the ability to collect funds from customers, make the deposit, do the bank reconciliation, and write checks, right? That's way too much responsibility around one person. You would not do that. Separating operations from custody of assets and accounting. So it's making sure that any one person's responsibilities would not allow them the ability to defraud the company, separate certain functions from each other, have proof and security measures, have sign-offs, have documentation, have security measures in place. And by security, we mean simple things like video cameras, loss control people, a fireproof safe, alarms, things you can do to protect your inventory, like putting high value inventory behind a glass case, things like that. Okay, so again, control procedures, it says here, just the same ones we just got done talking about. Shielding the management and the business, obviously. So monitoring, obviously we need to monitor controls, find weaknesses and improve them as we do that monitoring. It includes observing employee behavior and the accounting system for indicators of control problems. You're looking for anomalies in financial statement numbers that might be an indicator of control issues. So just some warning signs of control problems in regards to people and their attitudes or behaviors. A change in lifestyle without winning the lottery. Close social relationship with suppliers. Refusing to take vacation, borrowing from other employees, excessive use of alcohol or drugs. And one that I am aware of, based on personal experience, is large medical bills. And that's one that you need to be thinking about too, in my opinion. Warning signs based on your accounting system. What are some things that you might notice coming out of your system that are indicators of control issues? Missing documents or gaps in transaction numbers, okay, which means some fraud might have been done. Unusual increase in customer refunds, right? They might be phony. Differences between daily cash receipts and bank deposits, means some receipts are being put in somebody's pocket potentially. Sudden increase in slow payments, okay? The employee may be pocketing the payments, so our payments coming into us slowing down. Backlog in recording transactions, right? We're trying to delay detection of fraud. So just all things to be thinking about in looking for fraud. Internal controls can provide only reasonable assurance of safeguarding of assets and processing accurate information in compliance with laws and regulations because the human element and cost-benefit considerations. Obviously, nobody's perfect, right? We make mistakes ourselves, and so those are just some things to think about. The cost-benefit considerations, obviously, an example I always come up with when I was CFO of a company, every check required 2 signatures, right? I was one of the main check signers, and there were 6 of us in the office that could sign checks, and that would mean that we would, for every invoice, for every payment made, we had to review all the supporting documentation. If it was an invoice, a purchase order, a bill from the outside that we were paying, whatever it was, we had to review it, verify that sign-offs happened that needed to, then ultimately sign the check. And it would take a while to do that. And 2 people had to do that for every check written. And you're talking in an average week, probably over 100 checks. Well, we could require, let's say, 6 people to sign checks. All 6 people had to sign the check before we would issue it. Well, that's a lot of time. That's going to take, there's a potential error of getting our checks out on time to be timely with paying our bills and not incurring late fees. Plus, just does everybody have the time in their week to do that? And the answer is no. So you can put in some controls that are really super strict, but are you really getting enough return out of that? Are you going to find enough issues to get that effort paid back? And the answer probably in that case is no. But 2 people signing a check just means if I know I'm the main check signer and other people continuously find issues on checks that I've approved, I better step it up. I know that somebody else is going to be looking at the same thing that I did, and I better find the error before they do. Okay, let's apply controls to cash. And of course, cash includes more than just what we consider to be cash of obviously coins and currency, checks and money orders. When we talk about a business, we're also talking about cash in the bank, and basically just any financial instrument that's very easily turned into cash that's in a bank. So let's talk about controls over cash receipts, right? So cash comes into a business typically two ways. Customers purchase products and services from us, and they make the payment immediately, or we provide our good or service to the customer and they pay us later on, basically on account. So we deliver the good or service now, they pay us back later. So over-the-counter sales at the cash register obviously is a very big control we have to be worried about. And so here's just a good flow chart to kind of show what we should be doing. Obviously the customer shows up at the cash register, and cash registers at most businesses are very sophisticated computers, and they can hold a lot of information, especially with barcoding and scanning. So the customer shows up. Just imagine that the goods are being put on a conveyor belt, and the cashier is scanning it, and that cash register is recording all this information internally. It's recording an electronic receipt, and that receipt goes to accounting, where journal entries are happening. The cash should go to the cashiering department. Typically, most retailers are going to empty cash drawers every so often. There's going to be a pretty secure spot in the back of the store somewhere where cash is going to be controlled, be fairly safe, be in a vault. And then every day that cash should be getting to a bank. Okay, so once a day, somebody from the cashiering side should be getting cash, checks, anything we've got that can be deposited into a bank, because the safest place for that to be is the bank. Okay, and so obviously that bank is going to issue a deposit ticket. That deposit ticket goes back to accounting, who also made the journal entries. And obviously with barcoding and scanning, those journal entries are just happening automatically. But we know the journal entries made in the day for sales. We know how much was cash versus credit card versus whatever else. And we should be able to match up to the penny the amount of my deposit for that day plus my accounting for the day. They should be exactly the same. But notice that we split those duties up, right? We've got a cashier. That cash register is internally recording these sales. That salesperson can't change those without some kind of a supervisor to help override something if a mistake was done. Cash is going to one department, accounting's happening in another department, and we get a deposit ticket to match up the fact that the two departments did the right thing, that they agree in the dollar amount deposited. A predetermined amount of money that's given to each cash register clerk in a cash drawer is called a change fund. Typically, I used to do this in high school. I worked at Kmart in a few years of high school, and you started out with, I forget, I think it was around $100 between ones, fives, and then the various coins. That was your change fund, which you started out with, of course. And then at the end of a shift, what we did is you had to count. You ran a report out of your cash register that said, here's the amount of your sales that you had based on check, based on cash, based on credit card. And that report then would tell you how much cash you were supposed to have, and cash and check you're supposed to have in your drawer. So you counted that. We filled out a form. I counted it at the end of a shift. A supervisor did the same count. We both initialed the document, so we each came up with the same dollar amount. And then we compared that to the amount of sales, and occasionally they'd be a little bit different. Maybe if I gave bad change or whatever it was, and that's the cash shorten over account that you just kind of use to account for those differences. And so here's an example. This company had cash sales on the day of May 3rd $35,690 per the register tape. This is probably just for every register that day. After counting the change, I mean taking out the change drawer fund, that came up with $35,668 left over with a $22 difference. And so we used that cash short and over account then to balance out the entry. And if that account has a debit balance, we treat it like an expense. If it has a credit balance, we treat it like revenue. Okay, which is what they just said right there. If it was a credit, we treat it like a revenue account. How about cash received through the mail? So just from your perspective, think about any bill that you get that you write a check for or write in your credit card information, put it back in an envelope and send it back to a company. Okay, happens all the time. And for me, having worked in insurance for a long time, a lot of premiums are paid through the mail. Basically, they did quarterly billings, depending on how, depending on what the customer wanted. It could be quarterly, it could be annual. You send out a bill, and that bill at the end of it had that part you could tear off called a remittance advice. And then when we sent out the bill to the customer, it had the big envelope that contained everything inside. So inside was the bill along with the prepaid with a envelope that already is pre-addressed. And so the customer gets that, takes the bill out, takes the envelope out, tears off the remittance advice, writes in their information, puts a check in the envelope, or maybe their credit card information was on there, seals it, stamps it, we get it. And so what would happen is you'd get these huge tubs, these white tubs you get from the post office, full of these envelopes that have these remittance advices in them along with checks. Of course, what you also try to set up is what they call EFTs, electronic funds transfers, which is really the preferred method to get billed or to get repayment, because there's a lot more controls regarding EFTs. And so basically what you're doing is you're getting your customers to give you their bank account information, basically their account number and their routing, bank routing information from their particular bank, so that money could be transferred from their accounts to the business's bank account, however often you would agree to do the billing. If it was monthly, quarterly, annually, whatever you set up. I would guess many of us probably have a lot of our bills paid that way. I have a lot of my insurance, property insurance, things like that, I have done that way. Just get a notice every month. Here's the amount that we're going to take out, and it's going to come out on this certain day. So an EFT just means the customer and the business have agreed that the business is allowed to basically send electronic information to the customer's bank account and have a transfer happen to pay the bills that way without having to write a check. EFTs are encouraged for a number of reasons. They cost less in processing cash payments. The controls are better because you don't have employees handling cash or checks. EFTs reduce late payments from customers, and they speed up processing of cash receipts. In fact, when I was in property management, we gave a $100 bonus to customers who would be willing to set up some kind of an EFT. Either they gave us a credit card number or the EFT information. If they paid their rent that way, they got $100 off their first month of rent, just because we knew the odds of collection would go way up if we had some kind of electronic payment. And I will tell you, circling back to receiving the cash or the checks through the mail, at Salmon's, they had a mail room, obviously, and in that mail room was about a lot of people, about 10 people, whose job was they ran those envelopes through a machine that would open them automatically, but then what they had to do was every day take those envelopes and separate the check from the remittance advice, and they put the checks in they had these organizers that put the checks in one organizer, the remittance advice in the other one, and of course I had to make sure the information on both was the same, that if somebody wrote in they're paying $100, that the check was for $100. There's all kinds of little things I had to look at. At the end of every day, the remittance advices went to accounting, who updated every customer's account to show a payment, and the checks went to the cashiering department, or treasury as we called it, and treasury then made a deposit. At the end of every day then, that deposit had to be the same amount as the accounting to customers' accounts, and those numbers had to be the same, and they balanced that every single day. Now the issue with employees opening envelopes is it's time consuming, and let's just say a check that came in was not written out to anybody. It was just blank. What's keeping an employee from taking that check and putting it in his or her pocket and writing in their name and going and cashing it later? Something like that. Obviously there was a few controls in place to prevent that from happening, but it could still happen. EFTs, that's not going to happen. Control of cash payments now. So let's focus on the payment side. Basically making sure that we're only paying authorized transactions and that cash is used effectively and efficiently. Some businesses use what they call a voucher system, which is a set of procedures set up to authorize the recording of liabilities and cash payments. Of course, it could be manual or computerized. Not everybody does it that way, but some businesses do. A voucher is in some kind of a document that serves as proof with some kind of authorization, so somebody or some people have signed off on it, that authorizes a payment to be made. Okay, so let's talk next about controls around bank accounts. A major reason that businesses use bank accounts is for controls, of course. Some control advantages of using a bank account are as follows. The reduced amount of cash on hand, right? I can just simply write a check or do some kind of a transfer to make my payments. The bank records a listing of transactions, right, that comes from the bank. They send us the bank statement every month that shows here's every deposit, here's every payment, here's every withdrawal, here's everything that went through your account for the month. And of course facilitates the transfer and use of the EFT system. A bank statement, then we get that from the bank once a month. Basically just shows every transaction that went through our account. What was the beginning balance, what were all the deposits, what were all the deductions, and what's the new ending balance. So we all should know what one looks like, but here's an example of one right here. So here's the name of the businesses on here, the account number, the time period, the beginning balance, deposits made, withdrawals made, other things that were done, some debits and other debits and credits, and our new balance. And then here's a list of every single check that went through, and plus some other types of transactions that are coded with some letters here. Error transactions, miscellaneous, NSF for not sufficient funds, ACH for automated clearinghouse, which is those EFTs, SC for service charge. Let's talk next about debit and credit memos. Basically, we've got the two sides of them. On the right hand side, let's talk about the bank side. And for a bank, the liability company's account, and if they have a debit memo or a credit memo, debit memos are for EFT payments, service charges, NSF checks, bank errors. Credit memos are also for EFT deposits, note receivable collections, loan proceeds, interest earned, and bank errors. And just notice the errors, see if you can follow those. So the liability account balance then, basically for the bank, it's for them, it's a liability because the company, if we have cash in the bank, just think for the bank that's a liability, right? It's not their money, it's our money. So it's an asset for us, it's a liability for the bank. Okay, and increases to that liability are the credit memos, and decreases are the debit memos. So just notice that for a bank, the debit memos, okay, are decreases to asset or credits. And the credit memos are the opposite, which are debits. Okay, and seems like every time I do this class and I teach the rules of debit and credit, I always have somebody who's worked at a bank and says that your debits and credits are backwards. Well, it's just banks that use their debits and credits are the opposite of everybody else's. Okay, it's just one thing to keep in mind. So the rules of debit credit, as we've learned them, remember those, but just know that for a bank, they're the opposite direction. So here are some of those same codes that were on the bank statement. It says next here, using the bank statement as control over cash. Right, that bank statement gives us some really good information. It's coming from an outside source, so it's the best kind of source document to have. And then we can use that to reconcile or make sure we've got some good controls over our cash account. The company we're looking at is called Power Networking. The bank statement says they should have $3,359 worth of cash. If we look at our internal records, we have a different number, $2,549. Does that mean one side made a mistake and they better fix it? The answer is no, not at all. All that means is that both sides don't have the complete picture yet. And so we're going to do a reconciliation and reconcile those numbers down to a common number. That's just called the bank reconciliation. I'll say bank recon a lot. An analysis of the items and amounts that cause the cash balance reported in the bank statement to differ from the balance of cash on the ledger. Right? You simply just look at your ledger account for cash. What's that ending balance versus my bank statement balance? Are they different? Odds are yes. And if they're different, how do we reconcile down to a common number? So it's divided into two sections, the bank section and the company section. The bank section begins with the cash balance according to the bank statement and ends with the adjusted balance. The company section begins with the cash balance according to the company's records and ends with the adjusted balance. And so you can see here the goal is to get down to the same number. Okay, so we've got the top section is the bank side. We start out with the bank statement balance with additions and deductions. Then we get down to the company side where we've got the cash ledger account with additions and deductions to get down to the adjusted balance. The goal is that both adjusted balances have the exact same number. So there are lots of steps to follow to do this. The bank side, enter the cash balance per the bank statement. Add deposits not yet recorded by the bank. So if we made a deposit and the bank has not recorded it yet, we would add that. And then deduct outstanding checks that have not yet been paid by the bank. Keep in mind the bank does not know we've written a check until that check is presented to the bank. We know as the business, the moment we write a check, we know that we did, obviously, right? The bank doesn't know until that check is presented for payment to the bank. So that's going to cause some differences. Then we have the company side. Again, we start out with a cash ledger balance for cash. Add any credit memos. And we already showed us what those credit memos were. It said potentials are a note receivable or interest that the bank has collected for the company, or deduct debit memos, which basically are NSF checks or bank service charges with a few other things too. That should give us then the adjusted trial balance number, or the adjusted number that's the same as the book side. Okay, and that's step 9. Make sure that both sides have the same number. And so just to walk us through an example here, it says Power Networking prepares to reconcile the monthly bank statement for July. The bank statement balance is $3,359. And so that should be basically step 1, the debit right there on the bank side. Step 2 is a deposit in transit was not yet recorded on the bank statement. So quite often what happens is if you ever go to a bank and do a transaction, there'll be this little statement sometimes by every teller that says certain items done after a certain time of day may not get recorded that day. So it's possible the bank has like a 2 o'clock, 3 o'clock, 4 o'clock cutoff that day for transactions. And let's just say you made your deposit towards the end of the day, maybe 5 o'clock. The bank maybe has already kind of shut down and started processing for the month already. And so they didn't include that in your July 31 balance. We did because we made the deposit that day as the company, but the bank did not. There's nothing wrong with that. It just means it becomes a reconciling item. So there it is. Step 3 is some checks were written that did not appear in the bank statement. So checks we wrote, sent out as payment to whoever we had to pay, and they just had not been presented to the bank yet. You can see that there's 3 of those, and the grand total is $1,544.99. And so step 4 is my adjusted balance at $2,630.99. So I do then basically the same thing, only now for the company side. And per our cash ledger, the balance is $2,549.99. So I put that one in, step 5. Step 6 then is a credit memo on the bank statement shows that the bank collected a note for us. So somebody owed us money, and they made that payment directly to our bank for us, which is not unusual. We could have given them that information to send payment to the bank, okay? Which just means that money gets in our bank account faster. So it's not a bad reason to do that. And that included $400 relating to principal and $8 worth of interest. And so because the bank collected cash for me, I'm going to add that to my cash balance of $408. Step 7 is then basically one customer wrote us a check. We deposited that check thinking it was good, but when our bank presented that check to the customer's bank, it bounced. Okay, and so that $300 check was returned to us along with an $18 fee. So we deduct the NSF check fee and then some bank service charges of $18. And then we had an error. It said check number 879 was for $732.26 to Taylor Company. It says the account was erroneously recorded on our journal as $723.26. When an error is made, basically ask 2 questions. Who made the error? Which side of it? The bank side or the book side? And does the correcting to the error cause cash to go up or down? Power Networking made the error, so it's on the company side. So we place it on the company side of the bank recon, and it says that by correcting the error, the cash account goes down. Okay, the check was for $732. We recorded as $723. We should have deducted it for $732, so we did not take enough out of the cash account by the difference between $732 and $723, which is $9. Basically a transposition error. This typically result in an error of 9. 19, 29, 9 in this example. So deduct that error, which then gives us my new adjusted balance, and both sides agree. That was the goal, right? Both sides had to agree. That's step 9. Now, any transaction that was on, let me go back a screen, that was on the company side over here on the right side, this addition and all the deductions has to result in a journal entry. Okay, we have to record that because ledger says cash is $2,549.99, but my bank statement says it should be $2,630.99. So I have to do journal entries to get from one number to the ending number. So I got a deposit of 408, or an increase to cash of 408, and deductions to cash for 318 and 9. And that's what this entry will do. Okay, is record the debit to cash and the credit to cash, and now my new cash ending cash balance will be the same as my bank recon. So here is then the bank reconciliation with all the steps listed out. Special purpose cash funds, petty cash being the most common. Petty cash is just cash kept on hand by the business to be able to pay small amounts. I was a petty cash custodian once upon a time in my corporate life. I kept a fund of $250 that people came to me to use for various reasons. Office supplies, an impromptu business lunch. Those are probably the biggest 2 that we used it for. This company is using $500, so the entry just to record it initially is just to debit an account called petty cash, and then take $500 out of your normal cash account, basically cash that, and put that petty cash in a safe place in the office. It says the only time petty cash is debited is when the fund is initially established. That's the only time you do it. And then you credit petty cash if you have to decrease the fund. So basically what happens is, as I was using petty cash, as people came to me using petty cash, typically at the end of the month, I would just replenish it. And that meant pulling out all these receipts, and I always had somebody fill out what they call a petty cash ticket. And I would write a journal entry to replenish petty cash, debiting various expenses, and you can see some examples here: office supplies, postage, store supplies, miscellaneous. And we would debit the various accounts that were impacted by petty cash, and then credit cash. And basically that just meant writing a check, which we then cashed and put back into the petty cash drawer, so it was back to its total amount. You can also use some special purpose funds for payroll or travel expenses. Quite often many companies will set up a separate account, a bank account just for their payroll. They'll just fund that every payroll period. They'll just make sure and transfer the funds needed to pay payroll right to that account. There is some extra controls if you do something like that. So to report cash and cash equivalents on the financial statements, typically a company has a lot of extra cash. You want to invest that in something, get a little bit of a return. Obviously money in a bank account, you hardly get any interest at all in checking or savings. So quite often companies will put extra cash that you can still access easily into something called a cash equivalent, maybe a short-term mutual fund, a money market fund. You get at least a higher return than a savings account. And so typically you'll have a line item on a balance sheet that says cash and cash equivalents. Basically anything that is cash or that is very easily turned into cash just by literally just calling up your bank, or quite often you can just go onto your bank's website and just transfer money and turn it into cash easily. Banks must require depositors to maintain minimum cash balances, called a compensating balance. Quite often, especially with business accounts, a bank will say you have to have a minimum of a certain dollar amount, otherwise we're going to charge you fees and things like that. It's called a compensating balance. A few ratios involving cash. It says ratio of cash to monthly expenses is a good ratio. It just kind of shows you, do you have enough cash on hand typically to pay for your monthly expenses. So it's useful for companies that are more in startup mode or potentially in some kind of a financial distress. It says also ratio of cash to monthly cash expenses. You can see negative. If I have some cash flow from operations that's negative, I can divide that by 12 and compare that to my monthly cash expenses. That's called my cash burn rate. So if my business does not generate enough cash and it uses cash, this gives me a good feel for how much cash that I have on hand, how long will it last me before I either go belly up or I obtain new financing. Okay, so that was internal controls.